If we look back over the past 10 to 15 years, we can see that the financial markets experienced unprecedented growth, particularly during the 10 years after the global financial crisis bottomed out. During this period, the stock market scored one of its best decades, and since then, the earnings of the S&P 500 have roughly doubled, while the price has more than tripled. Undoubtedly, the major catalyst for this growth was cheap money, as the highest interest rate during that period was only 2.5% in 2019, making it easier and cheaper to access money. As a result, businesses were able to expand, investors made more money, and valuations grew. By the end of 2019, it seemed that whatever one bought, it would double in no time. However, this bubble burst due to the pandemic, and the historic decade-long run came to an end. Investor enthusiasm started to wane, and they began pulling their money out of the stock market. The pandemic led the world into chaos, businesses were shut down, and the financial markets collapsed. The recession was dark, and the world of investment was brought to its knees. Central banks around the world started printing money to help their governments cover some of their pandemic-related expenses. Similarly, the U.S. Federal Reserve printed trillions of dollars, and ultimately, the printed money was flooded into the economy in the form of stimulus checks, bailout packages. But the free money couldn't save U.S. citizens. This debt monetization inflated the economy, and the U.S. had to deal with a 40-year high inflation rate in June of 2022. Now, U.S. citizens are living with decades-high inflation, with everything becoming out of reach on a year-over-year basis. When we look at where inflation is, we thought we could say it peaked last month, but it did not. In fact, it matched the all-time high in this cycle at 8.6%, and the core rate was up 6%. After inflating the economy, the U.S. Federal Reserve again jumped in and started raising interest rates, but the consequences of this action are awful. This rise has made it difficult for businesses and citizens to access money, and these aggressive moves have halted the economy, with panic spreading to financial markets. We saw a free fall in cryptocurrencies, many big names in the corporate world are struggling, the real estate sector is falling, and the equity market is declining as well. A major sell-off from investors can be seen in the wake of fears that the world is on the brink of a terrible recession. The question is, what is the right time for investors to enter the market? Is it when the markets are already at their peak, or when everything is on sale? In the investor's world, it is a known fact that crashes are the best time to become rich, and crashes usually occur after a long time. Therefore, no one can say with confidence that people will see another time in their lives when everything will be on sale. But is this the best time to build your wealth? Let's dive into the answer and see whether this is the right opportunity, and if yes, how one can take advantage of this time. Since 1926, the United States has experienced 11 bear markets and 15 recessions. If we include the pandemic-induced market drop of 2020, the bear market count would be 12. In terms of cumulative numbers, bear markets have lasted for a total of 15 years, while bull markets have persisted for 75 years. Despite the scary nature of bear markets, it is a fact that those who invested during these periods have been rewarded well. For example, those who invested during the Great Depression enjoyed returns of around 265% over 4 years. Subsequently, later on, people made 43% in just 2 years, 210% in 4 years, and over 900% in 15 years. These trends continue, as those who invested in recent bear markets enjoyed returns of 20% to 50% in just 12 months. While there is no perfect time to invest, these trends show that bear markets can be great opportunities. Some people should not own stocks at all because they get too upset with price fluctuations. If you're going to sell stock because your stock goes down, you shouldn't own a stock at all. There is deep psychology involved in investing, and the simple idea of investment is to buy low and sell high. However, people do exactly the opposite. They buy high and then sell when it's low. The reality is that they don't understand the market, and they don't have a clear investment strategy. Investing requires patience, discipline, and a long-term perspective. One of the biggest mistakes that people make is trying to time the market. They think they can predict when the market will go up or down, and they try to buy and sell accordingly. The truth is that nobody can consistently time the market. Trying to time the market is like trying to catch a falling knife. You might get lucky once or twice, but eventually, you'll get hurt. Another mistake that people make is investing based on emotions rather than facts. They might hear about a hot stock tip from a friend or see a company's stock skyrocketing, and they decide to invest without doing any research. Investing based on emotions is a recipe for disaster. It's important to do your own research and invest based on facts, not emotions. Having a clear investment strategy is crucial for achieving success in the market. One of the key components of this strategy is setting clear goals. This involves determining what you want to achieve through investing, whether it's saving for retirement, buying a house, or simply building wealth over time. By setting clear goals, you can create a roadmap that guides your investment decisions and keeps you on track. As Warren Buffett once said, if you don't know how to evaluate individual stocks, then buy a low-cost index fund instead. This is a wise advice for those who are new to investing or unsure about their ability to select individual stocks. Index funds allow you to invest in a diversified portfolio of stocks, bonds, and other assets, without the need for constant monitoring and adjusting. Another good tip would be dollar cost averaging, which is a popular strategy among many investors. Let me break it down for you. Dollar cost averaging involves taking your money and diversifying it across the stock market by investing in index funds like the S&P 500, which is the largest index fund in the world. This means that you're choosing a market tracking investment and investing the same amount at regular intervals, let's say $2,000 biannually, and then your money is split across the entire market. This strategy is designed to give a long-term reward to the market, which usually averages around 10% annually for the S&P 500. And the best part? It doesn't require you to time the market or seize an opportunity during a market crash. Let me give you an example. Let's say you invested $2,000 in the S&P 500 on October 9, 2007. That would have bought you 12.78 SPY shares. Fast forward, a year later, when the market was on its way down, and that same $2,000 got you 20.5 shares. See how that works? You buy more stocks when they're lower and fewer stocks when they're higher. It's that simple. This is an excellent way for passive investors to seize the opportunity. But for those of you who want more control over your portfolios, you might want to consider Warren Buffett's style of long-term value investing, which involves purchasing individual companies. This approach requires a bit more research, but it can be incredibly rewarding. Keep in mind that Warren Buffett has an impressive track record, with an average annual return of 20.5% from 1965 to 2019. So, if you're willing to put in the work and find companies with a competitive advantage, this approach might be perfect for you. To ensure that your investment strategy is aligned with your goals, it's also important to review your portfolio regularly and make adjustments as necessary. This means taking into account changes in your personal circumstances, market conditions, and the performance of individual assets. Investing is a long-term game, and having a clear plan that includes diversification, regular review, and adjustments as needed can help you achieve your financial objectives. Overall, investing can be a great way to build wealth over the long term. By developing a clear investment strategy, setting clear goals, and diversifying your portfolio, you can increase your chances of success in the market. However, it's important to remember that investing is a long-term game, and there will be ups and downs along the way. With patience, discipline, and a clear plan, you can navigate these fluctuations and achieve your financial goals. Thanks for watching. If you found this video helpful, please give it a like button and don't forget to subscribe for more investing tips and insights. I'd also love to hear from you in the comments section below. How do you prefer to invest for the long term? Do you use dollar cost averaging, individual stock picking, or a combination of both? Let me know in the section below.